Good morning, folks, and welcome to Swing Trading Today. This is Bob Desmond at the Contrarian Trader, and it is 5:10 in the a.m. Eastern Standard Time. Let's get to a trade that we took off the table yesterday. We booked profits in the Contrarian S&P 500 Bear Leveraged ETF. I spoke about this yesterday morning on Swing Trading Today, and I said that I wanted to book profits because I was a reluctant long. The futures were down big, and I said I don't believe that we are going to continue to sell off. Sure enough, we rallied back again off the lows of the day. Why was I negative going into the day yesterday? A couple of reasons. First, I'll talk about the chart of the SPXS. We had a nice consolidation here at the 2450 level, and we began to rally. But as you can see here, we had these topping tails, hollow-filled candlesticks, these black-filled candlesticks, which imply indecision, a lack of conviction, meaning that we were rallying and then sellers were coming in and taking the shares off the highs of the day. And I found that disturbing, and I executed a trade reluctantly because I was using an intraday chart. And when I pulled back to take a look at the daily chart and to see how we had closed, I was rather disappointed. And so I mentioned to members on Market Wrap that I would probably sell any rally on Tuesday, and that's exactly what we did. We booked a profit, nice scalp. Why else did we sell? Simply take a look at the S&P 500. Now, I'll grant you, the S&P 500 has lagged the small caps and the micro caps because of the trade wars, but rarely absent a geopolitical event, a banking crisis, war, a volcano blowing up somewhere. Rarely do you get a stock market, an index as large as the S&P 500 that simply just goes straight down. It's a process. And you might argue, you know, Bob, we peaked out back in January of 2018, and you could argue that it's been a process of us putting in a top here and we're about to roll over. Okay, maybe in hindsight that would be an accurate call. In particular, let's go to a weekly chart for a moment. In particular, when you take a look at a weekly chart, you could argue that we've peaked out, pulled back, rallied. If we break down below the 2500 level and close there on the S&P 500, it's all over. I would buy that argument. But as it stands right now, we are in a trading range. We have not broken down. The bull market is still intact until it is not. It's as simple as that. So when I take a look at the daily chart here of the S&P 500, yes, weak. But when I see that we are rolling over on volume on Monday, which was fairly light, yesterday it did rise, I have to ask myself the question, as we near a support level, do I want to be short? Given the price action on the SPXS, given the fact that we've been rallying off the lows of the day on the S&P 500, buyers have been stepping in? Or would I rather wait for a rally and an attempt to try to take out this prior high, and if it fails and breaks back down, re-short, because my risk to reward is far more favorable. So that's the reason why we booked our profits. And moving into, back to the SPXS, moving into Wednesday, you could see that we had closed out the day at resistance at the 20-period moving average. I'm kind of happy that we did. Let's go to the pre-market activity. Then we'll come back here. We'll go over some watch stocks and some members' stock chart requests. Okay, let's kick things off with the S&P 500. We're up 8.5 points this morning, or just shy of a third of a percentage point. We have broken out above resistance on RSI. As you can see here, we were in a downtrend channel. We have broken out. Moving on to the Dow Jones, and I was shocked to read that GE, not really shocked, but disappointed. I mean, the end of an era. GE was removed from the Dow Jones Industrial Average. yesterday, and you could see that we are up triple digits this morning, just shy of a half percentage point on the Dow. The Dow has lagged the S&P 500 names. Is this a dead cat bounce? Maybe, but as it stands right now, we are above resistance. So, and these are all 4-hour charts, folks. So we're looking good moving into the trading day. Let's take a look at the NASDAQ. The NASDAQ has broken out as well on this 4-hour chart. If you want a visual, here you go. And there's your breakout. In fact, we broke out, pulled back, rallied back, bullish key reversal, and now we are seeing a continuation move higher, and we are up just shy of a third of a percentage point on the morning. Let's take a look at the dollar. The dollar, which has been very strong. This bar here, 4-hour bar, opened up only a few minutes ago at 5 a.m. Eastern Standard Time. So it's a fresh bar. We broke out of this pennant formation yesterday after the close. So the path of least resistance remains higher for the U.S. dollar. And here's our upper band of resistance. There's going to come a point, folks, where the dollar is going to come under some pressure because we need to understand why the dollar is rallying. It's rallying because of the trade war tensions. But two things or both can happen. One, concern with regard to the negative impact of these trade wars on the U.S. economy could filter through to economic data, which is already weak, and earnings data, which would be very disappointing because the market is already very expensive. And what I just pointed out here on this line I just drew is that while we've been moving higher on this 4-hour chart, we've seen a negative move, lower highs on RSI, no breakdown yet to lower lows. One might argue you had it here, but no, I'm not going to buy into that. I'll stick with the lower highs. I'm watching for a break on RSI down because what RSI should be doing right now on this move higher, it should be breaking out with price, but it's not. So early stages here, maybe nothing. The dollar is up this morning, but keep an eye on it. Let's take a look at the price of gold. Gold this morning is down. And here's an interesting factoid in that what we're doing here is that while we're seeing lower lows on gold, you can see now we have this trading channel formed. Let's throw some lines up here, or some colored lines, I should say. Okay, so in blue, we have our very short-term trading channel. And what we're looking at here are higher highs getting put in on RSI while we're putting in lower highs on price. So going back to the dollar, higher highs on price, lower highs on RSI, back to gold, lower highs on price, higher lows on RSI. So what we're seeing is a bit of a divergence, nothing to trade off of, folks. I would not go jumping in saying I'm getting long of gold because of what Bob just pointed out on the 4-hour chart. It means nothing yet until we begin to see serious breakouts to higher highs in RSI on gold and lower lows on the dollar, and then eventually want to see price follow through respectively on both charts. Let's take a look at the euro. Euro is sloppy. All right, so what we're watching right now on the euro, I'm looking for early warning signals of a break in the dollar because that would mean a move higher for gold. Now, once I start seeing those bullish divergences for gold, then what I would do is I would look to build on our gold mining position. Not until then. Right now, it's just, there's nothing going on. But you could see that the euro is in a trading range, a very tight one. We're putting in higher lows on price. We just don't have a breakout yet. So that's what we're looking for. If it fails and we break down below this lower band of support, we avoid. Let's check out the yen. These are the two major trading currencies versus the US dollar. And you can see that the yen is behaving somewhat better than the euro because we broke out here on the 18th, rallied strong, pulled back, we're consolidating. We are holding the rising 20-period moving average on a 4-hour chart. What we're looking for here, folks, is a rally up and through this upper band of resistance. If you get the yen breaking out along with the euro, especially the euro, versus the dollar, you're going to see the dollar drop. That would be bullish for gold. That's what we're looking for right now. If it doesn't happen, if these weak currencies remain weak, well, then there's nothing to add in terms of gold until we see lower lows on price. Simple as that. Let's get to our watch stocks for this morning. Costco daily chart, bullish key reversal yesterday. We were a bit overbought. We've consolidated nicely. We're looking good here. Stokes rising. RSI rising as well. Volume yesterday a bit light. But what we're looking for here is a rally up and through this level here, 208.11. That would get us excited about Costco. I'll be sending out an alert. Deckers, love this setup here. Daily chart, we were overbought. The froth has come off of RSI. And you may be saying, you know, Bob, RSI is still at 76. What are you talking about? Technical analysis for dummies taught me that if an RSI goes above 70, it's overbought. Well, if you listen to that rule of thumb, you're going to go broke. So we broke out yesterday on a bullish key reversal out of this trading range. I'm liking this setup here. Members, if we pull the trigger, I will be sending out an alert. Volume could have been better. If there's one caveat, that's it. Stokes are rising. We use a trailing stop loss order on this because despite the fact that I mocked an indicator, a rule of thumb that's out there in the trading community about an indicator, the RSI, I'm not going to ignore the fact that we are putting in lower highs right now on RSI. I want to see us begin to trend up higher along with price. So we'll use a trailing stop loss order. GOOS. Now, I was very bullish on GOOS, and longer term, I may be bullish on it. We were bullish on GOOS from back here down in the 30s. It's now up in the mid to high 60s. This goose is cooked for a while, folks. If you are long of these shares and you are holding on to profits, don't lose your profits. Do I believe that it's going to collapse? No, but I do believe that we are going to pause and pull back. We're looking to short the name. And that short, the logic behind the short has nothing to do with the fundamentals. That has nothing to do with the price target of dropping back down into the 30s or crashing into the 10s. Nothing of the sort. All I'm looking to do is to scalp a profit off of a pullback, which I think is going to be short-term aggressive. We have RSI on a daily basis at 93.26, and we are leaning into the third standard deviation Bollinger Band. In short, if you're not familiar with what all this means, we're not supposed to be here on a relative basis. These are foolish longs getting long of the shares at extended prices and shorts who are weak getting squeezed. Simple as that. As contrarians, we want to identify the unsustainability of this move higher, and we want to take advantage of it by shorting into this unsustainable overbought condition. Again, we're not betting that GOOS is going to drop like a rock down even into the 50s. It may not. I may even think about getting long of it 2 weeks from now. But we are going to get a pullback. As sure as God made green little apples, it's going to happen. Ideally, though, these volume bars need to drop off further. Still too much ridiculous enthusiasm driving these shares higher. So members, more to come in terms of strategy. And the last trade that we did, that was an extreme overbought trade that we shorted, was STAA, right up here. We scalped this trade. And when I was talking about it, people were asking, what are you kidding? You're going to short this thing? Yeah, we shorted it. We made a profit. Member stock chart request. JP Morgan. I don't like the money center banks. I like the regional banks, of which we added more to or added back to yesterday. Now, the money center banks are sloppy. Might they pick up steam here? Sure. But JP Morgan put in a nice double bottom setup back here. First leg of the double bottom setup was in February. Second leg in April. It was unable to break out. In fact, we pulled back, broke down below the lower band of support. Very disappointing. So until such time that we recaptured and closed back above 108 per share, I would avoid the shares because we're putting in lower highs and lower lows. Ultimate oscillator. No divergence here. Lower highs and lower lows. RSI. Lower highs. Not so much lower lows. We appear to be stabilizing here. Stochastics in a trading range, but putting in lower highs. So if this is a long-term investment and you're fundamentally bullish on the shares, then fine. Open up your position. Just use a stop at least. Give yourself some room at a maximum below 103.46. If you want to keep it tight, keep your stop right below a range between 104.96 to 106.27. And until you get a rally up above 108 to 108.50, I would avoid the shares. Look at the regional banks. They're doing a lot better. ITA, this is the aerospace and defense ETF. Folks, I never thought I'd say this about defense stocks, but avoid right now. They're not looking good. We broke out back here to a new all-time high in April, but we rolled over and we couldn't hold those gains. It's a breakout point failure. We pulled back. We did put in a higher low. We held the 183.79 level. So at best right now, we are in a trading range within a bull market. The bull market is not over yet, but I cannot go buying the shares of ITA until we pull back and retest either A, the 192 level, B, the 184 to 185 level, or C, which is my most favorite, a breakout above 207.47. That would get me bullish on the shares. On a weekly basis, we have RSI putting in lower highs, lower lows, Stokes lower highs, but we did manage to, back here, put in a higher high, but we're rolling over yet again. So I wouldn't trade off of Stokes until we could break out above this upper band of resistance. Volume to the downside, very, very serious. It's very strong to the downside, and the week isn't over yet. And look at this volume bar so far this week. And it's not as if we've had buyers step in and bid the shares up off the lows of the week. No, we're at the lows of the week. So this is all net selling on the week. Avoid the shares right now. Daily chart. Yeah, we got crushed yesterday on a breakdown below support. Now, we'll probably rally back in an effort to try to recapture 196. I think it fails. I think we're going lower here. Look at this volume yesterday. Huge volume. This is not mom and pop selling 100 shares. This is institutional distribution. Avoid these shares like the plague. That's it for this morning, folks. If you're watching me on YouTube, subscribe to my channel. If you watch this on the website, enter your email address. We'll send you out a couple of free trade tutorials, plus all the videos I ever do. And if you found us through StockTwits, Twitter, Facebook, follow me there. Leave a comment, and I'll definitely get back to you. Everybody have a profitable trading day, and be well.